Live from Bloomberg's world headquarters in New York City, we're tracking the key players, the major moves, and the capital flows shaping global markets. This is Bloomberg Deals.
Welcome to another episode of Bloomberg Deals, the only show dedicated to corporate action reshaping markets. Today, the Fed decides as banks brace for mounting geopolitical and price pressures. We'll look at how this macro environment is weighing on M&A in the banking sector. I'll speak with Tom Michaud, CEO of KBW. And for today's investment committee, we get the insider perspective on recent regional bank deals, like PNC buying First Bank and Fifth Third buying Comerica. Plus, big consumer deals. Unilever considers a breakup while activists circle Six Flags. Let's get straight to today's big deals. And we start in Europe, where there's been a lot of action over the past week. Unicredit making a $40 billion offer for Commerzbank, which will allow it to increase its influence. The German government, though, was opposed to a deal between the rivals. In an exclusive interview, Commerzbank CEO Bettina Orlopp told Bloomberg her firm was surprised by the offer and said it was not the right approach.
To bring us to the table to discuss, it's not necessary to do a takeover offer, because we repeatedly, and I repeat it again, we said that we would be absolutely willing to sit down and to discuss a proposal made by Unicredit. But there is no cornerstones of a draft or something like that available yet. And we think that it's also in the interest of our shareholders to ask for that.
For more, we're joined in London by Bloomberg Deals executive editor Aaron Kirchfield. Aaron, great to see you this afternoon. So Unicredit's been pursuing Commerzbank for at least 18 months. How does this move the needle?
Well, I think this move, the bid is Orchel, the CEO of Unicredit's attempt to break a stalemate. He used that term today when talking to some investors. And, the Italians have made this very clear. They want to do this deal. They want to create a European banking champion. But like all things in Europe, cross-border, they often become political. And I think this is the Italian attempt to kind of unlock some discussions, unlock some dialogue with this bid, even if, it's quite obvious that this takeover offer won't succeed. At the most, it will increase their stake beyond 30%, which gives them more flexibility going forward to build that stake.
Can I just say, it feels like all the action has been in Europe this week with the big ticket deals. I know you and the team reporting on a potential deal with KONE and TK Elevator. What's happening there, Aaron?
Yeah, we're excited over here on this side of the Atlantic to be busier than the U.S. for once, which isn't common. But yeah, we've also seen another attempt to create a manufacturing giant. So what we broke this week was that KONE, the Finnish elevator maker, is in talks to buy TK Elevators, the Germanic rival. And this would create actually the world's biggest elevator maker if it happens, surpassing Otis, a familiar name, stateside. So now the big question is, the owners of TKE were looking at an IPO, which would have been a marquee IPO in Europe, versus M&A. But given the volatility we've seen with the war in Iran, with private credit, with the software meltdown, let's be honest, owners might be keen to do a sale if they get the price they want. And that's why this deal is back on the table after 6 years of an attempt from the Finnish side.
Hey, Aaron, thank you very much for that reporting. That is, of course, the Bloomberg executive editor in Europe, Aaron Kirchfield. By the way, more action in Europe. And here to discuss another deal is Scarlett Fu, looking specifically at Unilever. Scarlett, what do you have for us?
Well, Unilever, Danny, is yet another consumer packaged goods company looking to separate its slower growing food assets from everything else, like personal care and wellness products. Over the past decade, Unilever has reduced its exposure to food, first by selling off its spreads business, including the I Can't Believe It's Not Butter brand, and last year by spinning off its ice cream division into Magnum Ice Cream. Unilever still holds a 20% stake in that, and it'll be selling it down in coming years. Now, its remaining food brands include Hellmann's Mayo and Coleman's Condiments. And according to Bloomberg reporting, Unilever could spin off its entire food business, keep some brands while separating the rest, or keep the current structure. It's still early days regarding timing. Any change may not happen before 2027. Now, Unilever is not alone. You think about Nestle, it plans to sell its remaining ice cream brands. Kraft Heinz was planning to split its condiments and grocery staples business, but the new CEO put that on hold and is investing more money into some brands. And of course, in 2023, Kellogg split into a cereal company and snack company, and both, of course, later taken private. Danny.
Well, Scarlett, to your point, it's not just Unilever. It's been happening in this sector. Why? What's the context for why major food companies are seemingly struggling to drive growth?
consumer tastes, an overall shift to wellness. Consumers want more fresh, less processed food. There's reduced demand for packaged food overall. And on top of that, you have the GLP weight loss drugs, which have changed how people eat. They want more protein, less calorie-dense foods. And of course, inflation. That means consumers are turning to cheaper store brands rather than paying a premium for brands. According to Bloomberg Intelligence, private label sales are seen rising 27% between 2024 to 2030, while private label market share is seen rising to 22% from the current 20%.
Scarlett, thank you very much for that. Now let's get to some of the other big deals that we're watching. In the U.S., two self-storage rivals are becoming one. Bloomberg U.S. Deals managing editor Liana Baker joins us on that story. Also around the table is Bloomberg's Randall Williams, who has his eye on Six Flags and activists. Liana, starting with you, I mean, on the surface, package deals doesn't seem like the most exciting deal story, but it is a big ticket size.
I'm here to say, you might be talking about Europe today, but in the U.S., we're still seeing big strategic M&A. We had a merger Monday deal. This, storage behemoth, Public Storage, is buying National Storage. So that's the first, market leader in the U.S. buying the fifth market leader. And, the stocks are doing okay. This is a really interesting space to watch. We're expecting more consolidation. All eyes are on what CubeSmart does next. We're hearing that it was sort of competitive for National Storage, and with home sales and mortgage rates, pretty high, people aren't moving as much. So this sector has had a bit of a hangover since the boom times of the pandemic, when everyone was putting their belongings in storage.
Yeah, the macro pressures are really interesting. So the first biggest buys the fifth. CubeSmart might do something. Do we care about regulation, antitrust concerns in public storage?
It's a good question, but it's a very fragmented space. There's a lot of mom and pop brands. If you drive into any city, you might notice storage brands you don't know. So the space is pretty big already. So it's hard to say whether there will be, any antitrust angles here, but I'd say it's probably safe for these big roll-ups to happen.
Well, a lot of consumer stuff, I have to say, because you have Public Storage on one hand, and then the other hand, Six Flags, Randall, one you've been looking at with Jana partners pushing for changes. Well, what are they asking for? What is the activist doing?
Well, they're asking them to pursue a sale. And to set the scene, Six Flags merged with Cedar Fair to create the current company. So why is that important? So Cedar Fair is located, they have offices in Charlotte, but also they have one in Sandusky, Ohio, which is the roller coaster capital of the world. Travis Kelce, who's a brand ambassador, is from Cleveland Heights. That's about an hour drive. And so the Jana Partners board of directors, they applauded the fact that they have a deal with Travis Kelce as a brand ambassador. But of course, the overarching theme is that they want new leadership.
I thought, because a new CEO is coming in. Is that right? I mean, I guess when it's new leadership or even pushing for a sale, how realistic are these things as markets kind of slow down in terms of M&A?
I think it's to be determined. I mean, I do think from an amusement park perspective, like these are things that people want to go and see. But obviously, whatever Jana Partners is looking at is saying, hey, you guys have done some great things, but we think it's time to enter a new era.
Also, who could be mad at Travis Kelce being your spokesperson?
Travis Kelce has the energy of someone who attends these amusement parks, so it doesn't surprise me. And this is a hometown thing for him.
You really think this guy is going to Six Flags all the time?
Oh, look, have you been to Cedar Point?
I have not. I can't say
Cedar Point truly is the roller coaster capital of the world.
Okay, next deal show live from Cedar Point. I can't wait
we have to do it. We have to do it.
Thank you both so much. That, of course, is Bloomberg's Liana Baker and Randall Williams. Coming up on the show, my conversation with Tom Michaud, CEO of KBW, a Stifel company. You are watching Bloomberg Deals. One U.S. sector that some expect and maybe has already benefited from a deals-friendly Trump administration is financial services. The banking sector, though, has underperformed the year. The KBW Bank Index is off of its February highs, down nearly 9% year to date. My next guest is Tom Michaud, the CEO of KBW, a Stifel company, and KBW advises firms in the space. And Tom is the key voice in financial sector deal-making. He's been CEO since 2011 and oversees investment banking, research, and capital markets across U.S. and Europe. And he joins me now to take a look at the big picture. Tom, thank you so much for joining.
Great to be with you.
I have to say, it was coming into this new administration, this idea that banking M&A would really pick up. And we saw examples of that, certainly. But it feels like it's kind of mellowed out a bit in 2026. Is that the case? Are things starting to slow down?
Well, it does ebb and flow. So when you take a step back, the industry's been consolidating for a really long time. I think it will continue to keep consolidating. I think the buyers are somewhat busy because they're still integrating acquisitions that they've done recently. So I think it's a steady pace. It's not necessarily a big bang in terms of the consolidation, but I'll tell you, I think the Webster deal that happened recently was somewhat of a surprise to the marketplace, having a foreign entrant into the M&A game. And there's no reason to think that you couldn't see big deals like this happen again.
Well, which big buyers are left? Because you've had PNC, Huntington, Fifth Thirds, now Webster with Santander. Are there still big ticket deals that can be done?
I think there are. So remember, since 2021, for 3 years, in the end of the prior administration, no over $200 billion bank had bought another bank. There essentially was a big bank merger moratorium in the prior administration. So you would think those big banks are back. And number one is the economics of this consolidation does make sense for the industry. Scale for the typical bank does work. So scale is working. But now you have an administration that's willing to allow it in a safe and sound manner. So the banks feel like they're a little bit on the clock because we're going to get a presidential election in a little bit over 2 years, and then you don't know if the next president's going to think differently. So there's a little bit of a sense the industry's on the clock, which is part of the reason why I believe it's going to continue.
This is an administration that cares, one, deeply about affordability, and you've seen some of those concerns filter through to the finance sector, things like credit card caps and that nature. Paul Taubman was on the show last week and basically said, yes, deal making is back, but if it's impacting affordability, maybe regulators give it a second look. Does that impact the flow of deals? I think for affordability?
Well, I think what it is it's frankly pro-bank, this issue. Let me tell you why. Because this administration's working to level the playing field between banks and non-banks. I would argue that the playing field was stacked against the banks since the global financial crisis, with really the never-ending tightening of regulation and capital requirements. Now there's a level setting of the playing field, which I think puts the banks more on their front foot, which I think would probably support more M&A activity going forward.
So as I mentioned in the introduction to you, Tom, at one point, banks were reaching a high in February, and there was some commentary. Maybe there'll be less M&A because valuations look better. They feel more confident. They don't need to sell. Now banks entered a correction since the war started, inflation concerns, what have you. How does that type of market action impact deal making? Does it fuel it? Does it make a pause?
So if you look over the decades, literally, if we're in a recession, which no one's talking about now, but if you are, or if credit quality is the issue of the moment, that typically slows M&A. So if those concerns rise, there is a chance over time it will slow M&A. But all that being said, first quarter results, and we even held a bank conference this week, current comments are there are no signs on the credit quality spectrum now, at least in the banking sector. I know there are private credit issues, but in the banking sector, all is okay. And I would even say, look at the credit card companies, which in the last week did come out with a bunch of data that was all fairly consistent with expectations. So far, it's holding together.
There are certainly mid-market banks that lend to mid-market private credit companies. Have you seen any deals pause because of concerns around private credit?
No, not yet. I mean, I would say right now, nothing's leaked into the banking industry, and really the issues have been more around fraud. I mean, you can't really prepare for fraud. So it hasn't leaked into the banking industry, and I think actually this is a moment. This is a moment for the banking industry to say, hey, our underwriting has been more sound, and I think it's an important test, and I think the industry is probably likely to do well through it.
To be fair, there have been plenty of banks who have been exposed to some of that fraud. Do you think that there has been a reevaluation of exposures, of underwriting standards that's happened in the industry writ large?
Well, I would say yes. I would say that underwriting's generally probably going to get more conservative along anything that's levered or anything that's in the AI space. Doesn't mean that credit won't be available, but my instincts are that there will be a tightening of credit standards in those areas. But if you look at the core bread and butter economy, most of the feedback we get in our channel checks is that the economy is still okay at the middle market level. But, you know, if this war continues and if fuel prices stay at $100 a barrel for oil, you know, that could change.
That's exactly where I wanted to go. Let's say that this is more of a prolonged conflict. The noise from the administration is that it's short term. How long does this need to go on for there to be some serious damage to the sector and therefore deal making?
I personally believe it'd have to show up in the balance sheets. So by the way, you mentioned how the stocks are off. My expectation is when we get to the end of the quarter and see the results, banks accelerated their share repurchase programs. So look, analysts have expectations for share buyback. They're going to probably buy back more stock at lower prices, which if we can navigate through this war without too much damage to the economy, and the banks have done that, that'll be a good thing. So it's not like you can take all the good outcomes off the table yet. So it's unclear which one you will get. But if this did lead to a prolonged increase in credit quality, I think that would slow it down. But we don't see anything like that yet.
Hey, Tom, before you go, I do want to leave on Europe because we have this will they, won't they of Commerzbank and Unicredit, which has been happening for some time now. The FT reporting about a delaying of capital rules coming from the EU. What is your expectation in what European consolidation
there are some
like?
Powerful forces underway that I think bank consolidation is going to continue. I think financial services consolidation is going to continue. Even this week, you saw in the asset management space with Victory, you saw an increase in a takeover bid. So I think, and it's because financial services has become a giant collision. You've got stablecoin, digital assets, fintechs. There is probably a record number of fintechs today that are applying to B banks. So it's actually in some ways rather exciting, okay, that what's happening. And I think M&A across all these verticals is going to happen. So I think that's bullish. As long as the economy hangs in there enough, I think it will continue. But then there's the generational change in regulation, which isn't just in the U.S. We get lots of questions about the durability with this president to deregulation. But when you look to Europe, Europe is now joining the parade on deregulation of the banks. And I think they realize how far behind their big banks have fallen in terms of performance with the American banks. And I think they're letting up on the sort of the regulatory attack on their industry. So I think that's going to level the playing field, which will probably be good for consolidation in Europe, which I think will happen.
Tom, we're almost out of time, so I hate to ask you this one last question when we only have about a minute left. But is there some AI anxiety also within some of these financial services firms of new fintechs coming up? How does that change the picture?
So there is lots of AI. Now, we just had our biggest bank conference of the year about 4 weeks ago. And I would say universally the view is AI for the banking industry should be wind in the sails, not against the sails. Meaning, banks are going to use it too. Let me leave you with this fact. JPMorgan's going to spend $19 billion on tech this year. We couldn't find more than 10 American companies that are going to spend $19 billion on tech. Now, the hyperscalers spend hundreds of billions, so a lot more. But if JPMorgan spends more money on tech than most tech companies, that should prepare them pretty well for that moment. So my view is the banking industry, what's different, they got lots of earnings. These earnings can come to support their investments in AI. And they also have, I think, very good regulation. They've had too much, but very good, which I think makes them safer than some new entrants that don't have all that infrastructure. They should be able to join the AI movement and hopefully not get displaced by it. And I think they will adapt. So I wouldn't write the banks off on the AI. But I do think the future is, if you want to succeed, your efficiency ratio needs to get better. You need to be materially more efficient at doing your business because AI is going to drive it, and you better plan on it or else you're going to get passed by. And I see a lot of banks working to make that happen.
Tom, you're one of the best. Please come back again soon.
Thank you,
It's been
Danny.
such a pleasure to have you here.
Thank you.
That's Tom Michaud, CEO of KBW, a Stifel company. Now, speaking of JPMorgan, coming up, the bank hits pause on a debt deal. We're going to discuss why a certain $5.3 billion sale failed to win over investors. Also, we caught up this week with the CEO of IBM after the company's completion of $11 billion acquisition of Confluent. He discussed the speed of getting deals done.
I think the regulatory environment is definitely friendlier, where we got this done in just under 4 months, whereas it used to take a lot longer a few years back.
Time now for Alternative View, our look at alt investing. Morgan Stanley this week said default rates in direct lending will climb to 8% as advances in AI continue to disrupt the software industry. Robin Dumar, founder of Park Square Capital, told me that default rates will rise, but didn't see it at that level.
Right now, the leveraged loan market, which is probably the best liquid indicator of value, has traded off maybe 2 points since the beginning of the year, from something like 97 to something like 95. Now, within that, what's responsible for most of that drawdown is software, which is probably off closer to 10 points. So those are liquid marks. They're not signaling a 15 or 8% default rate. They're signaling a bit higher default rates. And we would expect that. It's late in a cycle. We would expect that normally. And then you have the AI overlay. What we're seeing, I think, within software now, even within those liquid marks in the loan market, is a increased differentiation where the high quality companies initially traded down, and now as people do their credit work, they're saying, wow, some of these businesses are extremely defensive, very difficult to tear out of an organization's enterprise, and risky to change. They may have embedded transactions in them. They may have a regulatory overlay. That's really tough stuff to change. Those companies are rising to the top. And things that are more speculative, remember we used to talk a bit about ARR financing and non-cash flow financing. That stuff looks really vulnerable.
And sticking with software loans, a group of banks led by JPMorgan halted a $5.3 billion debt deal for software firm Qualtrics International. That's after Qualtrics failed to win over investors as deepening anxiety surrounding AI disruption persists. Bloomberg News reporter Aaron Weinman has been covering this story and joins us now. Aaron, this AI anxiety is prevalent in public markets and clearly in loans as well. Just how much is it stymieing deal activity?
So I think it's a tale of sort of haves and have-nots. In the case of Qualtrics, JPMorgan and a group of banks attempted to engage with investors last month. And basically what's happened now is investors really like EA. So EA is the focus right now, and it's a lot larger. But Qualtrics is expected to sort of come back into the vision of investors in a few weeks' time. So they've effectively put it on the back burner because Qualtrics' existing loan in the secondary market has been taking a hit.
But didn't they also change the dynamics of the EA debt deal too?
They did, yes, they did. So what they've done with the EA debt deal is they've shifted the bonds and loans portion. So initially the talk was that it was going to be more loans, but now there's quite a large bond portion. To your earlier point about software, what you've seen is that there's about 15 to 17% of software related credits in the leveraged loan market, and that's sort of been bringing the index down. Qualtrics has been hit by that,
right?
And so that is why there is effectively a move by the banks to delay that and come back in a few weeks' time and re-engage with investors. And I guess the hope would be to launch the deal
hopefully
at that time.
Aaron, thank you so much for joining. Appreciate it. That's Bloomberg's Aaron Weinman. Up next, it's our investment committee. Welcome back to Bloomberg Deals. I'm Danny Berger. Let's go straight to Scarlett Fu, who's taking a closer look at regional banks and the state of M&A. Scar.
Well, there has been some deal making in the sector, but not necessarily to the extent that investors anticipated in the lead up to the second Trump administration. Regional bank shares, they are slightly higher since the 2024 election, even with Trump regulators being seen as hands-off in contrast to Biden's more aggressive approach to antitrust. Now, recent deal making includes PNC agreeing to buy First Bank for $4.1 billion in September, Fifth Third buying Comerica for $10.9 billion a month later, and this year, Spain's Santander acquiring Webster Bank for about $12 billion, while both First Horizon and KeyCorp have signaled that they may pursue some deals. According to Herman Chan of Bloomberg Intelligence, higher valuations are one reason why M&A has cooled. You can see how the S&P Regional Bank Index's price to tangible book value has steadily risen from the low in 2023 following the collapse of Silicon Valley Bank. Boards have less incentive to sell when their shares are trading at these elevated multiples, with earnings outlooks improving for many banks thanks to solid loan growth and expanding net interest margins. Potential sellers may feel more comfortable staying independent, and as a result, Danny, less pressure to have to do a deal.
Scarlett, thank you very much for that context. A big day on Bloomberg Deals here for FIG investing, and that brings us to this week's Investor Committee, where we take you into boardroom debates in real time. Today's theme is the banking sector M&A, and joining us, today's Investment Committee, it's Randy Paine, president of Key Institutional Bank, Angela Strange, general partner at Andreessen Horowitz, and Amit Garg, senior partner at McKinsey. Thank you three so much for joining. Randy, let me start with you. For this sector, where are the most attractive targets right now?
Yeah, I think as we just heard, we've seen an uptick in bank M&A activity, but I would characterize the environment as normalizing. You know, there was very little M&A activity under the previous administration. It was taking a year to 2 years to get things approved, and that's come in quite a bit. You know, it's a fraction of that time now. For KeyCorp specifically, it's not on our priority list, but in terms of other depository deals. But you know, we're very active in terms of just tuck-in knowledge-based businesses. We've bought some investment banks and done that very successfully. I think more broadly, lower rates are going to help fuel more consolidation, whether it's in the insurance space, fintech, and we are seeing that.
I'd be interested to get your take on it. I mean, is it the big deals or is it these more kind of like tuck-in things? Where in the space is the most attractive now?
You know, our view is that historically the big deals haven't really done the returns that everybody expected of them. So where the world is heading is what we define as precision M&A, which is about tuck-in transactions that add capabilities or extend the business into new business segments where there are attractive returns like wealth management, or really filling the gaps in your portfolio, certain markets where you are underrepresented or you don't have the right scale in certain other markets.
Angela, I'd love to get your take on this because obviously you're coming from a different part of the world, more startups, that VC type of nature. What would be your pitch to the investment committee? Where do you think is most attractive?
Yeah, listen, A16Z invests across all areas of the economy. I've spent the last decade in fintech and financial services, both at the very earliest stages and the latest stages. And the way we think about it is every technology product wave creates a whole set of opportunities. And as you look at mobile cloud, that brought us the neobanks, it brought us payment companies like Ramp and Stripe. And we're just at the start of AI, which is by far the biggest wave yet. And so I think we see an influx of new companies that are going to be competing with the banks. We see a lot of companies that are selling into the banks to help them become more AI enabled. And both of those categories are going to be very successful.
Can you put some more color on what those categories look like, Angela? What type of companies are the ones either doing the disrupting or getting bought by banks?
Yeah, we think there's a lot of activity in maybe 3 buckets. The first would be described as software augments labor. And so if you think of a specific example, usually banks would buy a software and then they would have to hire sometimes thousands of people to then operate it. Compliance is a very good example. And I'll use one of our companies, Sardine, which sells transaction monitoring. And usually you would buy this software and then you'd have thousands of L1 compliance officer doing research into all of the alerts. Now the software does the software and also a lot of the labor around it. And so you can think of, you can't hire enough compliance people fast enough. You can't train them. Every one of these minor tasks takes 15 to 45 minutes. That can now be accomplished with AI. And all of that is happening across various areas of the bank.
Randy, how are you thinking about deal making in terms of at KeyBank bringing in AI capabilities via purchases, via acquisitions, or growing it internally? How does that outlook appear to you?
Yeah, all the above. AI is going to be a game changer for banks and certainly KeyCorp. We really think we're in the sweet spot because we're big enough to make big investments in this area. We're going to spend $1 billion on tech investment this year, up from $800 million in 2024. But we're also small enough to deploy it at scale and do it quickly. And so we think it's going to be, just as you heard from Angela, a way to make for a better employee experience, a better client experience, as well as provide huge opportunities for us to get more efficient.
Amit, are you doing a lot of work here when it comes to AI enabling of various banks?
Absolutely. This is the topic that banks are really interested in. They're seeing real tangible benefits emerge. I think a year ago we were talking about AI as lots of experimentation. Now we see our clients really deploy AI at scale for both their client benefits and candidly to operate better and more efficiently.
I feel like we have to talk about some of the risks of M&A getting done in this sector. Randy, you're pointing at me being like, yeah, I feel like there's a big one out there, which is market volatility, concerns about war. How is that impacting your look ahead? Well,
I think if you think about bank investors, specifically regional bank investors, they really aren't all that bullish on M&A. They'd rather see banks, increase dividends, pay out, make higher levels of share repurchase or invest in organic activity. And that's why we have really, said we're not focused on bank M&A. But the other reason is for just what we talked about. M&A is highly distractive, and it's not without risk, the execution risk. And when you're talking about deploying this incredible technology across, scaled enterprises, we'd rather be focused on that.
Angela, I'd love to get your take on that. What do you think of that risk, that some of these things might act as a distraction and banks want to focus in on the core?
Yeah, I've got a strong agreement with Randy. Listen, banks spend $650 billion globally on technology, but 70% of that has historically gone to just maintaining systems. And the view has been it's too risky to replace them. This is the year where the risk of not replacing them is going to outweigh the risk of replacing them because the new systems are just so much better. For instance, now in mortgage servicing, usually you can get 750 loans per employee. The new systems will get you 3,000. The new companies think they'll go up to 10. They can reduce your time to get a mortgage from 40 days down to 20 days. So often M&A is helping you grow and become more efficient. Now, with AI and technology, you can accomplish the same thing even better.
I say there is some tension in there, though. Do you do these things? Does it maybe risk a distraction, or is it necessary? Amit, where do you fall into this?
I think it is necessary. If you don't disrupt yourself, you get disrupted. So I think we see that, yes, there is execution risks when you do big M&A, but if you don't actually invest in the right technology to continue to improve yourself, you get left behind.
What do you think for where we head in 2026? We started this conversation, Scarlett, saying all of the deals that have been done, we've had the big purchasers come in. I mean, let's expand beyond KeyBank itself, but the overall market, do you expect there to be a lot of deal activity in FIG, in financials this year, Randy, or do you think it might end up being more muted?
I think it's going to be a normalized environment. Certainly, a regain of more bank M&A, but I don't think there's any catalyst, and I really think that buyers are focused on how they can transform their business, with the deployment of technology. And that's a huge opportunity, as we've been talking about.
Mm-hmm.
Yeah, no, I think it will pick up. Even if you look at the price to book of the banks, yes, we are normalizing, but it still operates at a fifth of what the tech sector is or a third of what the industrial sector is. And at 1.5 price to book, there's still a lot of differentiation in the market where we'll see M&A pick up.
Angela, let me get your thoughts on this. Not only on where volumes look, but I'd love for you to comment too on how valuations stand for the industry at the moment.
Listen, I think that banks are very much leaning into AI in a way that we haven't seen across any of the other technology sectors. And it not only improves their efficiency, but also enables them to scale and serve a lot more customers. Like if you think of AI as a horizontal, you now have an army of infinitely patient, knowledgeable, available employees that work 24/7. And so you can hire you couldn't hire before. And you can also enable all of your employees to be more human. Do you want your wealth managers out talking to customers, or do you want them in the back office doing paperwork? And so I think we're going to see the companies that lean into this technology the fastest scale much more quickly, and valuations will come along with that.
Angela, thank you so much. And thank you to everyone in today's investment committee. That's Randy Paine, president of Key Institutional Bank, Angela Strange, general partner at Andreessen Horowitz, and Amit Garg, senior partner at McKinsey. Up next on the show, private credit on pins and needles as investors assess the impact of risks of software, of volatility from the war in Iran. We're going to discuss all those risks and the state of M&A with Rob Brown, the CEO of Lincoln International. You are watching Bloomberg Deals.
We're just about halfway through the trading day in New York. I'm Norma Linda. Let's take a look at your midday movers. First up, oil is surging as Iran pledged to retaliate after Israel attacked a key natural gas field. At the same time, Bloomberg News reports Vice President J.D. Vance and other key Trump administration officials plan to meet with oil execs tomorrow as the White House looks for ways to tame surging fuel prices. And U.S. stocks are under pressure amid the release of a Fed rate decision expected later this afternoon. Over in corporate news, Macy's shares are rising. That's after an upbeat quarterly sales guidance driven by resilient spending from middle and higher income shoppers. Still, the company struck a cautious tone with a full-year outlook that missed expectations, reflecting the possibility that tariffs and turmoil from the war in Iran could dampen spending. Meanwhile, shares of Lululemon are higher despite the company's forecast for a second straight year of profit declines. BNP Paribas analysts say that the retailer's guidance had something for both the bears and the bulls. The company said its guidance for the first quarter EPS was likely conservative to make sure the incoming CEO doesn't miss the quarter. And last up, consumers are set to start feeling the impact of the Iran war beyond just price hikes at the gas pump. U.S.-listed shares of Unilever are falling after BASF, a chemical company and one of its primary suppliers, said the cost for its products will jump by 30% or more. Those are your midday movers. I'm Nora Melinda.
A lot of the loans that are out for sale right now are pretty bad loans. So, we've seen some blocks of those, and they're not clearing at a price where we would be interested in buying them.
That was PIMCO President Christian Strack telling me this morning that private credit loans up for sale right now are pretty bad, though he didn't go so far as to call this a crisis, just said it's a cooling. Our next guest is behind the valuations for roughly a third of all U.S. private credit loans. Joining me now is Lincoln International CEO Rob Brown. Rob, thank you so much for joining. Really wonderful to get you on the show.
Thanks for having me.
So, okay, you have the perfect view on the ground of what's actually happening in private credit. You heard there Christian Strack saying that the things coming up for sale are pretty bad. John Zito warning earlier in the year saying that everything looks mispriced, and then kind of clarify that to say it was just software. What are you seeing? Is this a mispriced market right now?
So maybe back up a second, and you alluded to this. At Lincoln, in our valuation opinions group, we do 25,000 valuations a year. We value nearly a third of every LBO in the U.S. So it is a very statistically significant database, and we have the #1 share in valuing private credit. And part of private credit is this private direct lending, which I think is what everybody's been talking about. And our view, and again, we have access to all the fundamental data. We get down to the financial performance of the business. We know what the credit agreements say. We know what the loans to value are. And when we look at the underlying health of the private credit market, we don't have major concerns. There are some idiosyncratic headlines where fraud was involved. There's been this AI chill of what's this going to mean for long term for some of these loans into the software world. But if you cut through it all, one of the things we look at is payment in kind interest. And when you see that tend to spike, that means that's businesses that can't service their loans and they're starting to pay in kind. And there's good pick and there's bad pick. Good pick is the pick that's done at the time of the loan. Bad payment in kind is that comes in later because you can't cash flow the loans. Bad pick is up. It's up a little bit. I mean, picks, call it 11% of our total database, which means 90% of the loans are servicing the debt. And, if you look at default rates or this kind of shadow pick rate, shadow default rate, as we like to call it, back several years, it was probably 2-3%. That's probably 5-6%. So it is up. But every private credit lender also models in a certain level of defaults, and they model in a certain level of recovery. So there is uncertainty. But as we look at the underlying health of the businesses that are underpinning these loans, we think the headlines are materially worse than the financial health.
Are the headlines worse than the financial health, even when it comes to things like software loans?
So software is an interesting one because I don't think people are necessarily worried about. First of all, if you look at the software company's loans to the value of that company, it's like 30%. So there's a lot of cushion. There's a lot of equity cushion before you get into these loans being zero. I mean, a lot of these businesses would have to go to zero, and they have to go to zero quickly because these loans are actually being serviced. And if we look at the growth in our underlying database, about half the companies we value had positive EBITDA growth last year. The software were 70%. So I think the fear over the AI chill is, are these companies here 5 years from now? There's not a huge maturity wall coming up for these businesses in the next several years. And so these businesses are throwing off a lot of cash. They can service their debt in the short term. I think the concern, and again, some of the horizontal software companies are at much greater risk. When you look at the vertical software companies, and we're seeing this in the investment banking side of our business. We have lots of software companies we have for sale that are moving forward. There's new software businesses we're taking to market. So I think the existential risk is longer term for some of these businesses, And yes, there's going to be some bad businesses that default on their loans in software and other areas, but that's not new. That happens. So I think there is a longer term concern on that. In the short term, we don't see it being the credit crisis that others are making it out to be.
There have been certainly some wobbles in public credit markets and even leveraged loans, kind of the lifeblood for a lot of the LBOs, which Lincoln, of course, takes a very close look at, and you know intimately well. You have this ground level sort of knowledge of it. JPMorgan, for example, not being able to sell Qualtrics debt in the way that they would, rethinking the package of EA loans too. Is there any way in some of these wobbles are actually a saving grace for private credit? How does it change the contouring of how financing is getting done for deal making?
You know what's interesting? When you had SOFR, when you have much higher interest rates and much higher spreads, these private credit funds were getting 12, 13% returns. Well, all this capital flooded into them. When private equity is getting 16 or 17 and private credit's getting 12 or 13, guess what? Private credit is going to raise a lot of money because the risk return is much better. We've had multiple rate cuts. The spreads are down. Now private credit is under 10%. And so, but when it was up that high, there's so much capital that is flooded into private credit and to private lending. That capital's still there. That capital's committed. That capital wants to be spent on funding private equity and leveraged buyout transactions. So I don't see this being a credit crunch issue because there's an incredible amount of liquidity sitting in private equity and private credit that wants to be put to work. And so I think some of what we're seeing is going to affect pockets of this, but do I see a credit crunch getting in the way of funding the right private equity deals? We just don't see that because spreads are still relatively low, which means that this capital wants to be put to work and there's not enough opportunity to put it to work.
Just taking a step back, Rob, these overall M&A markets, they've faced a lot of headwinds. Last year, you get tariffs. This year, still trade concerns, these AI wobbles, and then at the same time, now we have to contemplate the geopolitical volatility of war. How do you see 2026 evolving? Will volumes be robust, or will it be more of a slow and steady year?
Maybe set the context of the back half of last year, because I think you have to look at that to determine kind of what we're expecting this year. There was a material pickup in M&A in the back half of last year. It was clear it was an improving market. Not yet a good market or a great market, but an improving market. And generally what you see in the M&A market is volume of M&A follows value. Last year was the year of the mega deal. You had a real spike in the ultra large deals. What we've seen in every kind of recovery of the M&A market is volume follows. So, and we started to see that a bit in the back half of the year. Our investment banking business, which is largely driven by M&A, was up almost 30% last year. And a lot of that was in the back half of the year because, as you noted, we had Liberation Day in April, and everybody thought last year was going to be a really bad year for M&A. It didn't play out that way. It shook that off and picked up in the back half of the year. And why is that? That is because the fundamentals are still good, right? Inflation has gotten under control. There's an expectation of lower interest rates. The underlying economic performance of our economy is good. So with those fundamentals good, with private equity having a backup of deals they'd like to sell, we expected and continue to expect this to be a good or an improving M&A market in 2026. There is no doubt, though, that in the last several months or last several weeks, we've talked about the private credit.
Injecting some volatility. Rob, apologies, got to jump in, just heading towards a commercial break. Really appreciate your time. That is Lincoln International CEO, Rob Brown. We end with the potential sports business shakeup north of the border in Toronto. Joining us is resident hockey expert Scarlett Fu. Scarlett, what are the details?
All right, according to TD Securities, Rogers Communications could sell a chunk of its Canadian sports portfolio to help pay down debt. But this would be a multi-step process because Rogers currently owns 75% in Maple Leaf Sports and Entertainment, which owns the Maple Leafs, the Toronto Raptors, and Toronto FC. It also owns 100% of the Toronto Blue Jays. So according to TD, Rogers would buy the remaining 25% for $4 billion Canadian, combine it with its stake in the Blue Jays and Sportsnet TV channel, and then turn around and monetize that by paying down debt by selling 30% to private investors.
I got to imagine they could get a pretty penny for that. I mean, sports investing valuations just continue to go up and to the right.
Absolutely. And Toronto is, of course, North America's fourth biggest city. It's got a pretty lucrative and dedicated fan base. And we've seen how MSG Sports has tried to do something similar. There's a pretty big gap between public and private valuations, which is hopefully narrowing a bit, at least in Roger's case.
It's going to be cool to see how this one prices. Scarlett, thank you very much.
Course.
Thank you for joining every day. And that does it for Bloomberg Deals. Stay up to speed. Subscribe to the Bloomberg Deals newsletter. This is Bloomberg.